Many of us can remember when prices kept rising, when every time we went to buy something it was more expensive than the time before. Fortunately, the days of persistently high inflation in Europe are at an end. Keeping prices stable is the primary objective of the Euro system as stated in the Treaty on European Union. And with good reason, since price stability helps to achieve sustainable higher levels of economic activity and employment through an efficient and productive use of resources. In order to measure price developments, the ECB uses an assessment of what people are paying for goods and services in the euro area called the Harmonized Index of Consumer Prices, or HICP. The HICP is calculated by Eurostat, the European Union's statistical office, which is in Luxembourg. It's based on a basket of prices, almost 2/3 of it made up of goods such as food, industrial products, and energy. The remaining third consists of services. The objective given in the treaty was further defined by the ECB, which decided that price stability should mean a year-on-year increase in euro area consumer prices of below 2%. The ECB also announced that it aims to maintain the inflation rate below 2%, but close to 2%. Although any amount of inflation carries a cost, a rate of inflation close to 2% provides a safety margin against deflation, which could also be very damaging. However, the ECB's influence on price levels is not immediate, as its actions have a delayed effect on the economy of between 1 and 3 years. That's why it aims to maintain price stability over the medium term, always looking some way ahead. In order to do that, it relies on both an economic and monetary analysis, which represent the two pillars of its strategy. The information gathered in this way is carefully assessed and cross-checked. As part of the economic analysis, the ECB looks at numerous key economic and financial indicators, such as wages, oil prices, the exchange rate, long-term interest rates, measures on real activity and fiscal policy, surveys of business and consumer confidence, house prices, and trends in financial markets. The economic analysis also contains an assessment of any shocks affecting the euro area economy and projections of key macroeconomic variables. In fact, there are a variety of factors that can influence the future level of prices in the short to medium term. However, long-term ongoing inflation can only take place to the extent that the central bank allows it by increasing the amount of money in circulation. If the amount of money in circulation increases too fast in relation to the quantity of goods available, then over a long-term perspective, the prices of those goods will tend to increase. That's exactly the reason why the economic analysis is complemented by the monetary analysis. The monetary analysis is based on a measure of the quantity of money in circulation called M3, which includes banknotes as well as bank deposits and other items which can easily be converted into cash. Monetary analysis serves mainly as a means of cross-checking, from a longer-term perspective, the short to medium-term indications obtained through the economic analysis. Based on the full set of information provided by the economic and monetary analysis, the ECB's Governing Council makes an overall assessment of the risks to price stability and can take action to influence future developments.